Episode 56. The 1956 Melbourne Olympic Games were the first games to be held in the Southern Hemisphere. 1956 was also the year when the bill to create the Trans-Canada Pipeline was put in place, and John Daly, at age 56 at last year's PGA Championship, completed his first round, downing 12 cans of Diet Coke, smoking 21 cigarettes, and 6 bags of peanut M&Ms. This, my friends, is what legends are made of. Beyond MD, episode 56, here we go! Hey everyone, thank you again for joining me on the Beyond MD podcast. Before we get into today's episode, I want to share a wonderful newsletter that I've been enjoying recently. It's called Post Call. If you're looking for a concise, informative, and humorous weekly newsletter created by Canadian doctors for Canadian doctors, I highly suggest you check out Post Call. It's excellent if you want to keep up with the news, clinical updates, a little bit of finance, and also job openings. And I have to hand it to the Post Call team because they shared an update that Patagonia Online was offering a 50% discount. And thank you to them, I was able to buy a new fall jacket for half the price. You can go ahead, sign up at postcall.ca/subscribe, and best of all, it's free. All right, so today's episode focuses on bonds, and I want to reiterate that bonds are not boring. The bond market is larger than the stock market and in many ways more complex. Bond rates dictate fixed rate mortgage rates, and bond rates today are in fact quite responsible for some of the volatility we're seeing in the equity markets. And the 60-40 portfolio, one that was thought to be dead for much of 2022, is certainly not dead. You can listen to a great interview featuring downtown Josh Brown recently on the Prof G podcast, and he emphasized that the 60-40 portfolio is very, very relevant, and I would tend to agree with him. So the goals from today's episode, after listening, you should be able to understand what is a bond, what are the different types of bonds, how do bond ratings work, what's an investment grade bond versus a non-investment grade bond, what is basic bond math, how does that work, and if you're investing into a bond ETF, what exactly are you investing in? Now, I mentioned bonds are complex, so we did not have time today to dive into the yield curve and also to investigate the spreads between corporate and government bonds and exactly what that means, but these topics will be reserved for a future episode. And if you're looking to invest into bonds using a professional corporation, Dr. Mark Soth, the Looney Doctor, came out with a recent, very timely article on how to best go about that. I have posted a link to his article in the show notes as well. So as you guys know, I do my best to try and find somebody who's an expert in the space to come on the show. So I'm happy to have Rounak Langhe on the show today. Rounak has been a fixed income investment professional since 2003, and he believes in fundamental securities analysis and a value investing approach. And he has strong analytical and investment decision-making capabilities and a very deep knowledge of Canadian and global fixed income environments. He's currently managing 2 funds at Durham Asset Management. One is a corporate bond fund, a portfolio of corporate bonds domiciled in Canada, and the other is a mortgage income fund, which is a portfolio of second mortgages on residential homes in Ontario. So Rounak and I had this conversation back in mid-July, and some of the numbers that we mentioned are not going to be as relevant today because since our conversation, bond yields have absolutely surged. It's fascinating stuff. So with that, please enjoy my conversation with Rounak Langhe. Okay, Rounak, welcome to Beyond MD. It's really nice to have you on the show. To be honest, I can't believe it's been 3 years that I've been doing the podcast, and I haven't yet had an episode on bonds, so I think it's been long overdue. But before we get into bonds themselves, I wanted to just give you a chance to tell us a bit about yourself and also tell us a bit about what you do and your experience in fixed income investing.
Hey, Yatin, thank you very much for bringing me on this podcast. And I have seen your previous podcast and I really like what you are doing. So a little bit background of me. I came to this country in 2003, routing through US, where I completed my MBA. In investing, and from a reference from there, I started over here with a company called Aegon Capital Management. I did join them as an analyst, fixed income analyst. Worked there, covered all the sectors of the fixed income. Usually they are less than equities, but there are now number of sectors. But because I worked there for 7-8 years, I had an opportunity to move from sector to sector. The team was very small, so obviously everybody has to do everybody. But that gave me exposure to the whole fixed income sector. That was a good point which came out of that. Within 7 years, I think in 2010, I was asked to choose to continue between analyst or a portfolio management. I chose the portfolio management. I was given a small portfolio of fixed income to run and manage, co-manage the other funds. By the time I left Aegon Capital Management, I was managing about $7 billion. And then I came the investors group. They approached me. They wanted me to be in their Toronto office. So I moved with investors group. And by the time I left the investors group to start my own company, I was managing about $2.2 billion of direct portfolios. Those portfolios were corporate bond, government bonds, high yield contributing to high yields. I had ETFs contributing to ETFs trading, and few other kind of whatever fixed income. So I'm fully exposed to all kinds of fixed income securities. And then this has been almost like now 20 years for me working in the fixed income sector.
And can you give us a quick snapshot of the company you started, the company you run today?
So company I started is Durham Asset Management in 2018. It took me some time to get the approvals for all the regulatory approvals. This is a highly regulated business or industry, and you have to take a license for everything. So Durham Asset Management is registered as a portfolio manager, exempt market dealer, which is basically equivalent to any other asset management company which does the business of mutual fund. So after that, I decided to start one mutual fund because I am expert in fixed income. That was only my forte. So I decided to start a corporate bond fund. In June of 2019, we started a corporate bond fund, got it approval in January of 2021. So we are almost there for 3 years. That is one product which Durham Asset Management sell. This is all sold through the financial advisors. Currently, we are approved on your RBC platform, Align Capital, National Bank. If any of your clients wants to buy that, it has to go through a financial advisor. The other product which Durham Asset Management is now is a mortgage fund. This is a mortgage investment corp. A lot of your clients might know about it. And we started this last year. We have just completed 1 year. I'm happy to tell you that we have more than 20 clients now, and we are approaching $1 million of assets. Those are the two funds which we are in future. For us to be a full-fledged fixed income expert in the market, which I'm trying to be, we will need about 4 or 5 more funds. And out of those 4 or 5 funds, I can list high yield is on our priority. Then we have a liquid alt, which will be a corporate bond fund plus a leverage, a universe index, which means either a Canadian government bond index or the universe by itself. And then obviously there will be a little bit of hedge fund, which is a total return. There's a combination of all kind of strategies the fixed income portfolio manager can implement, and the returns will also be targeted as a total return, net return, rather than the index-based returns. This is my vision about Durham Asset Management.
Very nice to see you guys making progress. And what I do want to do today is take all of your experience in fixed income investing so that you can educate myself and my listeners about bonds, because I do believe myself and many others, we have a heavy focus on equities, and we understand equities much better. But the truth is the bond market is in fact more robust, bigger than the stock market, probably more complicated as well. So let's just get started, Rounak, and talk about what is a bond. And maybe this is a good chance, in addition to giving us the basic overview, to go over some key definitions of coupon rates, maturity dates, etc.
That's a pretty good question and a pretty basic question. What is bond? In a layman term, not giving the proper definition, this is a contract between two parties where one party lend the money to other, in a simple term. So it's a contract, and what does a contract includes? Obviously, it includes the rate which the other party's borrower has to pay. What is the time of this loan, and then other certain conditions. What happens? So that's between two individuals. But let's take this up and say, okay, what about the organizations or governments? Everybody needs funding. and everybody needs debt. This whole world runs upon debt. Even 80% of the capital market is debt. So government takes money. Obviously, they have a standardized contract. And same is for the corporation where there's a standardized contract. What we look into the contract for the bond is basically three C's. One is, what's the character of the borrower? Does he have an intention to pay it or not? How is his business? And then obviously we also talk about the collateral. So sometimes or the investors demand, what is the collateral behind it? If something goes wrong, what will happen? What do we get? What rights we have on the assets against what we are giving you as a loan? That's the second one. And then obviously we figure out the capacity. Will you be able to pay the interest rate? At the minimum, we check the interest rate, and then obviously we also want to know whether the principal will be paid back or not. So that's how we analyze the bond. But in its layman terms, bond is simply a agreement from borrower to the lender with certain terms and condition. Obviously now they are private debt and the public debt. Public debt is what is traded. Canada bonds, government bonds. Private debt is between the, say, for example, small business owner, restaurant owner borrowing from somebody. Those are also called the bonds, but they are all practically called loans.
Okay. And so the term of the coupon rate, which we often see, so that is basically the rate of interest that the borrower is going to agree to pay the lender, right? And then there's also a maturity date by which, let's say you're buying these bonds individually, then the maturity date is when you would theoretically get your principal back, right?
Yeah. So at the very start, there are a few things which is set there, which is called a bond indenture, or if you want to say it as an agreement. Coupon is decided on the day the things are issued. We also decide the term, which is number of years this will be repaid back. Then we also talk about the interest payment. When and what the period will be. Most bonds pay 6 months interest, and all government bonds do June and December. Corporate bonds can do anything, but because the government bonds are very standardized, they always do June or December. They already issue also in the in that period too. Even if they issue, say, in March, they will only pay for the first 3 months, so that to keep the June and December very much the way we want it. It helps the market to remain disciplined and structured. Everybody know when the money is coming in and when money is needed. So those three things are definitely the coupon payment, and the maturity is defined very much on the very first day.
Perfect. I think you've already partly answered my next question, which was just an overview of the different types of bonds. So you've spoken about government bonds, you've spoken about corporate bonds, and I know that there is this other category, which I guess we could call high yield bonds, also sometimes referred to as junk bonds. But can you just touch on that last one a little bit, just to give us a broad-based overview? I know that diving into this in depth is beyond the scope of this episode, but what do we need to know, the basics?
So let me touch on the first part. So bonds issued by anybody, you can call them as a category. So corporate issues becomes corporate bond. Government's issues, so there's a Canadian bonds, US treasuries, Euro bonds, Japanese bonds, those are all called government bonds. Just to give a little bit of to your viewers, they are important sector because the default rate on those bonds is very much minimal. We usually call them risk-free rate, which means because if you buy a through US Treasury giving you 3% for 5 years, I can assure you there is a 100% guarantee that in 5 years you will get the 3% return, because the government has a power to print the money. So they will never default. If they don't have money, they just print more.
Yeah.
So that is why they're called risk-free, default-free, and their rate is the lowest because they have the lowest risk. And then we go to the corporate bonds. Corporate bonds are like, there are industries which are risky. Through the equities, what is the beta, or what is the risk associated, what is the volatility associated with. There are certain sectors which are very volatile, certain sectors. It same implies to the bonds too. So those are called corporate bonds. And those are corporate bonds because most of their equities is listed. Okay. So they become corporations. But if you are a private entity, you can still issue the bond, but you will call it as a private debt. Okay. Now the question to which you asked, what is junk bonds or where this term come from, the junk bond? So to analyze the bonds and their associated risk, as I said, government bonds, no risk. They will no default in 5 years, 10 years. We know that, but that's for the big. Argentina defaulted, Russia defaulted. Those are their different stories and why they happened. Okay. But in terms of corporate bonds, we can analyze them and put something called probability of default. Okay. Which means what is the risk associated? Say, for example, a simple example, oil and gas rig. They issue a bond expecting that there will be a 10,000 barrels per day of production. Guess what? They got only 500. So there is a more risk that they will not be able to pay the bonds back or the interest associated with it. So we came out, rating agencies. There are 3 rating agencies now. There are practically 2, Moody's and Morningstar. They came up with this rating scale called a probability of default, and accordingly they rate all corporate bonds, just the corporate bonds, because that's where they are. So they start with AAA. All government bonds are AAA. Most of them, like emerging market, India is BBB or Pakistan is BB. Still, they know that the government can print the money, but then that money is also not any useful. Then we go to AA. AA is mostly like a big organization like GE and other names which have very vast sources of earning, very vast source of capital. So they are AAA. Then we come to single A, and then we come to triple B. And then obviously the things keep on going. Triple B, double B, B, triple C, double C, C, and then there is a last one called default. Anything which has already defaulted and underwater goes into the D category. So anything above triple B is considered as investment grade bonds. Anything under triple B is called speculative or junk bonds. So you notice that the risk from triple A to C is going down slowly. There is more risk if you go down the path.
Right.
So at one point of time, there's a triple B where they have said anything above that is investment grade because the probability of default on those bonds for next 5 years is less than 2%. That is why they call investment grade. That's how rating agencies report. If they analyze your company and figure out you will not default in next 5 years, okay, the probability of default is 2% or less, you will be given investment grade rating. So when you say investment grade rating and junk bond, obviously junk bond, like say for example, I'm giving you the example, it's not an accurate number. If investment grade average is about 5% yield, junk bond will have about 8%.
Wow. Okay.
Okay, all combined. So there is 3%. If you have a risk appetite, you can go, but still the bonds are not so bad because even triple B or a triple C, let me refer the chart in front of me. Triple C will have in 5 years, B will have a 5 years 16% default rate. So you are expected is that 16% you will lose. That is very similar to equities. Equity has a standard deviation of 10-11%. So that's there, but I think yes, you're right. C and D are much worse. C, if you're at triple C, 50% of the companies will go down in 5 years.
Wow. Okay.
But these companies are usually very small. They are project based. Very specialized bond investors invest into it, and they are always willing to take over the company.
Okay.
So that's the junk bond.
Thank you for that breakdown. Just one follow-up question. Now that interest rates have gone up so much, bond yields have gone up so much, to me it seems intuitive to think that you can generate a pretty healthy yield today, probably without taking on too much excess risk in the bond market. Is that correct?
That is correct. Here's another little bit for your viewers. Bond market, suppose you buy a bond today for X amount, and interest rate is Y on that and term is Z on that, or say 5 years, can you predict a price of those bonds 5 years from now? Yes, you can. But can you predict a 5 years from now a value of your equity? No. The reason is that simple is that in 5 years, the bond will be at maturity and the borrower will have to pay you $100.
Right.
So on that day, the price is 100.
Right.
So you know that. But in between these, bond prices will go up and down.
Exactly. Okay, we're going to get into this. Yeah.
So to answer your question, yes, the as we said, the returns is defined on the very first day when we issue the bond. Right now, the rates are higher, which means you are locking in a higher rate compared to last 2 years, 3 years. So yes, your expected return now for my fund, the expected return is 5.5% right now, compared to what it was 3 years ago, anywhere from 3% or something.
Okay, just to wrap up this part, so I want to make sure people walk away understanding what are the main determinants of yield on bonds. So we talked about the nature of the borrower. If we have a borrower who is likely to pay you back and there's really no risk of default, you should expect a lower rate of return, and then vice versa for a borrower which may be more likely to default, you should expect a higher rate of return because you're taking on more risk, right? And then also time, right? Usually longer term bonds, when you have a normal yield curve, they do tend to return more. But today, the opposite seems to be true in some cases. But are those kind of the two main determinants then of yield in the bond market?
Yeah, definitely. I mean, the coupon is the one which will define, and then term is also there. Okay. So usually there is a big math over here. What should a 10-year bond should return or 5-year bond should return? Because 2 5-year bonds is equal to 1 10-year bond. 2 5-year equal to 10-year. Because if you're looking at a time horizon of 10 years for your investment, you can do 5 years, let it mature, another 5 years, get it mature, or you can just buy 1 10-year bond. That's why we call a normal yield curve. Normal yield curve will always say that if there is a longer the duration, higher the return you are expecting, because the probability of default with each year goes higher, which means it's your higher risk.
Makes sense.
So a same company which has a 5-year bond, say for example issued at 5%, the 10-year bond will be issued at 5.5 or 6.
Okay, got it.
So yes, tenure to impact the risk associated with the bond.
Rounak, let's just go over some basic bond math. I want to make sure people understand this. So my understanding is that generally speaking, bond yields will move along with interest rates. So in the last year and a half, we've had rising interest rates, bond yields have been going up, but then the bond prices are inversely proportional to interest rates. So, back in the day when we had low interest rates, in 2021, early 2022, the outlook for bond prices, people would say it was a little bit bleak because as interest rates go up, they can only go up from how low they were. Bond prices should go down. But now we've hiked interest rates so quickly. To me, it seems like quite an interesting opportunity. Like for myself, right now I manage a lot of my own investments because I'm interested. But when I look at, for example, my RESP for my kids, where I have not a forever timeline, but a more medium-term timeline for that. Bonds seem like a really interesting investment inside something like that, because I feel like from here, there's a good chance in the next 5 years that interest rates come down, bond yields will come down, and therefore bond prices will go up, resulting in a capital gain. I just wanted to get your sense on this as somebody who deals with this day to day.
So definitely the value of the bond is inversely related to the yield. I can explain that. Suppose today, you buy a bond which is yielding 5 years, and we have a current rate of yield of 5 years is 5. So simply you will get a bond which has a coupon of 5% for 5 years, done, gone. 1 year from now, the rates goes to 6%. Now the value of your bond will go down. So simple question, why? Because it's simple. For next 4 years, when your bond matures, if you invest, you are getting only 5%. But if you take new money and invest at a yield of 6, you will get 6% for next 4 years. So that is why when the rate goes higher, the bond price, because it's adjustment. Everybody wants to get what is fair. because coupon rate never changes. So if coupon doesn't change and the rate has changed in the market, what is left to change?
Right. The price.
Value.
Yep.
So that the current yield or expected yield always remain the same. So in 4 years, 1 year after now, for the 4-year duration, you're making only 5%, but your yield is 6%. So what you do is that reduce the price of the bond from 100 to a little bit lower, and your current yield will become 6.
Okay.
That's a way of compensating to a new investment. So right now, I think in 2008 or 10 it started when the rate started going down. When the rate goes down, your valuation goes up for the similar reason. Your bond is right now making more money than a new bond which will be at a lower rate. So the value of your bond goes up. So we are in a situation where we started reversing it out. It's unfortunate for the people, those who have invested last year, they can't do anything about it, the valuation. But the new money will always be invested at a current yield, which is quite high right now. So if you have a new money to put in right now, your expected return will be 5.5% on a triple B, average triple B portfolio. But the rates are already at the peak. So what is the next thing to happen? The rates probably going down,
right,
to prop up the economy. And once the rate started going down, your bond value will go higher. So your return for the first few years will be higher. But I just want to remind again, at par, the price will be 100. So that is why we say fixed income is for a long term. Don't think about mark to market every day.
I'm happy you said that, but going forward over the next couple of years, it seems like to me, if interest rates do come down, bond yields come down, bond prices go up. For people, I don't want to call it trading. Like, I'm not saying I'm going to do this, but it seems like there is an escalation potentially to be seen in bond prices that it makes them appealing. But I hear what you're saying. At the end of the day, think about this as a long-term strategy. So Rounak, let me just ask one more follow-up question. So let's just say, theoretically, we're recording on July 19th, 2023. Let's just say for now, interest rates have peaked. So let's just say bond yields have peaked. If interest rates, let's say over the next few years, can only go down from here, does it not make it today an especially exciting time to be investing in bonds for those people who are looking to introduce this into the portfolio?
Definitely. So if you look at my post on LinkedIn, I think I did it day before yesterday, it was the same thing. If you think that rate cycle has peaked, it is a good opportunity to move your money, which is sitting in the cash or sitting on the sidelines, to move to the fixed income. And the fixed income returns will be much, on an average, higher than the total average. That's what I've been writing, and that's what I'm telling all my financial advisors and anybody who's looking forward to invest in the fixed income.
Okay. So myself and many others who listen to the podcast, we maybe have a fairly long time horizon. So the way we have traditionally been taught about fixed income, especially bonds, is that government bonds, like we've talked about, will probably offer uncorrelated returns to equity. So you have a market drawdown. These types of safe investments should cushion the portfolio. But then beyond all this, Rounak, and maybe it's very simple, but can you tell us beyond all this, like why would one be investing in bonds? Why would one have this as part of their portfolio?
So the bond portfolio or bond asset allocation is mainly for a few things. Definitely, it's slightly negatively correlated when the equities do bad and everybody is taking money out, running, and then where are they going to put the money? They will put in money in the bonds. In the portfolio, it helps as a cushion to the volatility. So if you have a 80-20 portfolio, which is to 80% equity and 20% bonds, you will not see the ups and downs which you see in a pure equity. So that's give a lot of people a peace of mind because they want to make sure that certain amount of their money is always there for them whenever they need. Obviously, then other question becomes, why bond? Well, it's a preservation of capital. Last year was the first year when we saw the negative returns on the bonds because of the interest rates going so much higher in such a short duration. Prior to that, we always understand that principal will get back. If there is no default, we will get our money back. All that we have to is wait. We may not be able to get that at the time what we want, but that also don't happen. It's very rare. As I said, 2% of the companies default. So that's called the preservation of capital. If you have enough capital, You have a succession planning. You want to give it to your heirs, pass it on to them. You don't want to put it in an equity or in where there is volatility. And if something happens and the portfolio valuation is minus 10%, and that's where what you're going to transfer. So to preserve the capital, that's one of the things. So it reduces volatility. You can sleep well. You will not see your portfolio changing too much if you have a bond portion in that. And it's a peace of mind knowing that your principal will not be deteriorated.
Okay. So now, in terms of the ways to go about investing in bonds, I know for people who are maybe more interested in this, perhaps they can buy individual bonds, even build their own bond ladder over different durations. But then for most people who don't have time for that type of maintenance, they may elect to invest in a bond fund, whether it's an ETF or a mutual fund. Can you just address the pros and cons of each approach?
So individual bonds, yes, that is a one approach if you want to take that approach. But I just want to remind everyone, the bonds are traded over the counter. They are not traded as equities, are electronically traded. At some point of time, you might see it as electronically traded on your platform or portal. But at the back end, there is somebody who's negotiating on your behalf to the other buyer. So it is difficult to get the good pricing. So if you have a large portfolio, probably yes, you could buy. But if you have a small portfolio, I would recommend remain away from the buying the individual bonds. Now we come to, should we buy a ETF or should we buy a mutual fund? The difference between ETFs and mutual fund, its only difference right now is that ETFs, you can trade intraday. You want to buy in the morning, you want to sell in the afternoon, you can do that. But mutual funds, you cannot. Mutual funds is priced at the end of the day every day. You can put your order, but you don't know exactly what price it will be done, because the pricing will be done at the end of the day at 4 p.m. then when the NPV is calculated. But let's put it this other way around, as we were talking about the risk. In ETFs, there is nobody managing your risk. It is what it is. Market, whatever it is. These ETFs are not actively managed. Mutual funds are actively managed by the mutual fund manager. They can trade intraday, different bonds, although the NAV is striked only in the evening, but there is someone who is looking for you or looking for your interest. If you believe in active management, you should go to the mutual fund. I understand that there are certain people who will come back and say the mutual funds fees are higher.
That was going to be my next question. I'm wondering how high are they for bond funds? I have some familiarity with equity funds, but curious what the range of fees would be.
So equity funds can go anywhere from, let's say, the minimum 1.50 to 3%. Bonds are basically starts from 40 basis points to 125. I've seen certain bond funds which could be higher because of they are balanced funds. There is equity also and there is a fixed income also. And then they club and make the one fees, but then unfortunately that's higher, and that higher fee impact the bond portion too. But for example, of the new funds which are coming, we understand that we are competing with ETFs. So the new funds are coming with a lower pricing. Say, for example, my corporate bond fund has 39 basis points of fees. So it's one of the lowest in managed portfolios. If you look at the ETF's fees, you can start with 6 or 8 beeps.
Yeah, basis points.
6 or 8 beeps. And go up to 24, 25.
Right.
Okay, some are at 30 also if they are saying actively manage ETF. So our fund is not so far away from in terms of whether you're paying in ETFs, but we provide a solution in terms of that there is a portfolio manager who is taking care of the portfolio. So yes, look at the pricing. Pricing is the biggest factor in returns. I'm not denying that. But there are cheaper options available. All you have to do is a little bit of research.
Well, Rounak, it is good to hear about the low fees for your fund. I wanted to just pick your brain, just because we come across a few ETFs in the Canadian bond universe. So one is XBB, one is ZAG. And I'm just curious, when you come across these types of bond funds, what is their composition in terms of, government bonds to corporate bonds? And then part two is, my assumption is that all the bonds in these portfolios would typically be investment grade bonds, but maybe I'm wrong. Can you educate us on that?
So the bond sector is divided into certain groups. One is Canadian bonds. which is the government
Yep.
bonds. Okay. Then the government bond is also divided into a few more.
Right.
Federal
Right.
bonds, provincial bonds, municipality bonds. And as you know, federal government is strongest, provincial is next, and the municipality is next. So you can expect the returns to increase a little bit more. So difference between a Canadian federal bond and a provincial bond will be 10, 15 basis point. And from province to municipality, the same. That is one big government sector. If you really want no default, nothing, you want to be very risk averse, go for those bonds. Now we come into the corporate bonds. Corporate bonds are also divided into AAA, AA, triple B. Most of the time, there is no AAA bonds in corporate bonds. There are very few.
Right.
There used to be one or two companies, but there are no more. And AA and single A, we usually combine them because the sector is so small. There are very few companies. So most companies are either A or triple B in investment grade. So you can find a ETF which is only triple B. So if you want to take a little bit more risk, you're happy with 2% default and you make 5%, go for it. And then obviously then we go lower the down range, as you said, junk bonds. There is one bond which is called Universe Mutual. Everything will be there. So current Canadian capital market, the bond capital market, total composition is government bonds, corporate bonds. So right now, I don't have the latest number, but it would be about 70% government bonds,
Right.
30% corporate bonds.
Okay, 70 to 30 in these funds. Yeah. So I was studying one of the ETF fact sheets and I came across some terms. I think my understanding is there, but I wanted to just clarify. So they had the average coupon rate, they had the annualized distribution yield, and then they also had the weighted average yield to maturity. I just want to make sure, like if my listeners are studying these sheets, these fact sheets, I want to make sure they walk away knowing what all these terms are. Can you quickly just give us a summary of what those terms mean? We already talked about the coupon rate, but the annualized distribution yield and the weighted average yield to maturity, what exactly does that all mean?
There are two kinds of yield. One is yield, which is basically what is the current coupon divided by what is expected in a term. So that yield is every time it's published. Whenever you see a bond, there will be yield, there will be coupon, yield. But then when they talk of yield to maturity, they're talking a little bit more in terms of you get the money every 6 months. Are you going to invest that money again back to the system or not? If you are doing back to the system, then they say yield to maturity. They are figuring it out. You get the money in first year, $100. So let's invest that also in the same bond or something like that. So that's how we calculate yield to maturity. Yield to maturity is also considered in certain cases. It's slightly technical term in a way too. There are certain bonds they only pay up to certain dates and then they don't pay it because bonds are it's a contract. We can design the way we want it. We can have a quarterly payments. We can have monthly payments. So yield to maturity is telling them if you hold till the maturity, your total return will be this.
Rounak, my final question is there kind of a good proxy for what our bond yield is going to be over the medium to long term? Like I think the yield on the 10-year US Treasury right now, I can't remember exactly what it is, but it's been as high as around 4%, give or take. But can we kind of use that as a good estimate for what long-term bond yields are going to be?
So if you look at the past data of 30, 40, 50 years, till 2018, I think the average return on equity was 10%, and average return on the bonds were 6%.
Yep.
I think that will stay, even though we see so much of volatility right now in equities too and in the bonds too. Bonds definitely we saw it. Last year it was a 10% drop, which never happens. So we should always, because we are long-term investors, we should always see that we get that breakthrough, that 6% average. So whenever you are investing in a bond portfolio or allocating something to your, assume that it will be 6. Last 2-3 years, I used to say, guys, just take it 3. But now I think we are back at where we can say 6% or 5%, 5 to 6% return. So it will take long time for everything to get absorbed, and we will make 4-5%, and then obviously someday we will again start doing the same cycle. Will start again, and the valuation will be hurt. But if you're long-term investors, as I said, hold to maturity, doesn't matter.
Those are all my questions, Ronak. Thank you so much. But do you have any closing thoughts that you wanted to share? I want to give you that chance.
So my closing thought to basically to all your viewers, investors, fixed income is an important part of your portfolio. I know when you're young, you at 30 or whatever, and you said, oh, I want 100% in equities. Yes, because you have a long-term horizon of 30 years for your investment, you do that. But you still need a very small portion of fixed income all the time to cover up your unwanted, unexpected expenses. Suppose sometime you need some money and the equity market is down. Do you really want to take the losses? Probably not. So have some portion in the fixed income. It used to be 60-40 portfolio. Now it's turned into 80-20 portfolio. If you're young, very young, have 90-10. But I would not recommend 100% equities as a prudent investor. Okay.
Fair enough.
So look into that. And then obviously always focus on the net fees, net of returns. Gross return doesn't help. And always talk to your financial advisors, legal counsel, somebody who can advise you on how to approach this thing. Nowadays, everything is do it yourself. Research as much as possible. Web is full of all the information which we need.
I know. There's information overload, to be honest. But sound advice, Ronak. I want to thank you for your time. Thank you for joining me today, okay?
Okay. Thank you very much. Nice talking to you.
So I will often pick topics to discuss that are of interest to me in real time. And it's not that I'm trying to place a bet on bonds right now, but I do find bonds to be quite interesting. As of date of release, the yield on the 10-year US Treasury is 4.95%, which is just nuts considering where we were just 2 years ago. So the 60-40 portfolio is most likely anything but dead. So guys, you know the drill. You can reach out to me at beyondmdpodcast@gmail.com. My links and Ronak's links are in the show notes. And I hope that you're going to join me in 3 weeks' time when we will start a series on one of the most polarizing and confusing topics in all of personal finance. Until then, stay well, stay savvy.